In terms of finance and in terms of how behavioral economics has changed finance and the way people think about managing money, what are your take in terms of how things have evolved?
Well, there are, I would say, two major ways. One is the question of the efficient market hypothesis. So, as you know, my golf buddy Gene Fama created the idea of the efficient market hypothesis. And that idea is that all asset prices are always equal to their true intrinsic value. And that any price changes are caused by news. Now, there have been a whole series of things. The first time I met Gene Fama was a couple of years after you first saw me, in 1987. There was a conference in Chicago to discuss the crash. So this was actually the spring of '88. So those of you who are too young to remember, October 19th, 1987, stock prices fell 25%
on no news, right?
On a day that nothing happened. The closest thing to a cause that any reporter could find was the Bundesbank had raised interest rates by 25 basis points. Now, normally that doesn't cause world stock prices to fall by 25%. And nothing else happened. The only news was that stock prices were falling all around the world. And, you know, it was a cascade. I think it may have started in Hong Kong, and the US fell 25%. And then the rest of that week, four of the biggest absolute changes occurred during that week. Monday it crashed, Tuesday it went up, Wednesday it went down. Now, again, the only news that was happening that week was that stock markets were going crazy. So if only news is generating this, then what's happening?
That's a problem.
So at this little conference in Chicago, Gene and I were on a panel, and Gene first said that the market was to be congratulated on how quickly it reached the new equilibrium. So markets are efficient. And then I asked a question to the audience. I said, how many of you think that the present value of dividends fell 25% on October 19th? And no one raised their hand. And Gene was sitting next to me, and he hadn't raised his hand. And I look over at him, and he goes like